Hey everyone, welcome to another homework help video. Today we'll be going over Chapter 9 homework in Cengage Financial Accounting. And this problem is on depreciation. And we have three methods of depreciation we're going to go over, and also partial year depreciation. We're going to be going over the straight line method, units of activity method, and double declining balance method. And let's get into it. The Purdue company purchased equipment on April 1st for $270,000. The equipment has a useful life of 3 years or 18,000 operating hours and a residual value of $9,000. And the equipment was used for 7,500 hours in year 1, 5,500 hours in year 2, 4,000 in year 3, and 1,000 in year 4. We're going to calculate the amount of depreciation every single year under this method. And because they give us that the equipment was purchased on April 1st, the first year of depreciation is going to be a partial year. And so January, February, March, no depreciation. So first, under straight line depreciation, we need to create the percentage of depreciation that's going to be had per year. In this case, it's 33.333%. Because we take 1 divided by 3, that's 33%, or 0.033 is the number we need to multiply by, and we multiply that by the depreciable base of the asset, which is 27,000 or 270,000 minus $9,000 residual value. We get 261,000, and we need to divide it over 3 years or multiply it by the depreciable base. And we're going to divide it by 3 here for simplicity's sake. $87,000 in depreciation per year. That's our rate. And to get our monthly depreciation, we divide by 12, 7,250 per month times 9 months of depreciation in the first year. We get 65,250. In year 2, we'd have the full depreciation amount of 87,000 because that's full 12 months of depreciation in years 2 and year 3. And in year 4, we only have 3 months of depreciation because this whole asset is going to be depreciated over the course of 3 years. But we started mid-year, we had 9 months. And so if we take 7,250 times 3 months, we get 21,750. And if we take, just to recalculate that our depreciation was correct, we can take 270,000 minus the depreciation every single year. And we get 9,000, which is the residual value. That will be the fully depreciated value of this asset. And so we're correct for number 1. Under the units of activity method, we create a per unit of activity rate. And in this case, it's 18,000 operating hours. And we have to divide our depreciable base of 261,000 divided by 18,000 hours. And we get $14.5 per hour as our allocated cost. And we have to multiply that by the amount of hours every single year. So year 1, we had 7,500. Year two, we had 5,500. Year three, we had 4,000 hours, so 58,000. And in year four, 1,000 hours, which is 14,500. Right. Now for the double declining balance method. And under the double declining balance method, we create our straight line percentage, which is 1 divided by 3, 33%. We multiply that by 2. We have to multiply the net book value of the asset at the beginning of the year. And this is easier for me to actually show you with a spreadsheet. The net book value at the beginning of the year is 270,000. Our straight line rate is 1 divided by 3. Our double declining rate is equal to our straight line rate times 2. And to get our year one depreciation for the full year, we take the double declining balance rate of 66.67% multiplied by 270,000, and that's $180,000 for the full year. But we're only doing a partial year, so we have to divide it by 12 months and then multiply the number of months by 9. So we get 135,000 of depreciation in the first year for this asset. And in year two, we have to take the net book value at the beginning of the year, which is the 270,000 minus the 135,000 in accumulated depreciation. And our value is $135,000. We have to multiply that by 0.667% or 66.67%. And our full year depreciation for year two is $90,000. And right, it's for 12 months, so we don't have to go into the monthly amount. And our remaining net book value is $45,000. And we're going to multiply that by our double declining rate to get $30,000 in depreciation. And our remaining net book value is $15,000. And if we take our rate times 6.667%, we get 10,000 in depreciation under this method in the final year. However, that would make our net book value less than our salvage value, and we can't have that. So we stop depreciating as soon as we hit our salvage value, which means that we're only going to have 6,000 in depreciation in the final year to reach our salvage value of $9,000. So our final year of depreciation is, I'm sorry, $6,000 because that's what takes us to $9,000. So thank you, everybody. that's the summary of how to calculate depreciation in each year for each of these methods. If you found this video helpful, make sure to like and subscribe, and you all have a nice day. Good luck with the homework.